ScanSource, ticker SCSC, just smashed Q4 fiscal 2026 consensus estimates across the board. I mean, revenue hit $953.1 million, which is up 17.3% year over year.
Right, and that easily clears the $812 million consensus.
Exactly. And adjusted EPS came in at a record $1.46, so that completely crushed the $1.14 forecast.
Yeah, and the forward guidance is, well, it's just as aggressive. For fiscal 2027, they are projecting 6% to 10% organic revenue growth and adjusted EBITDA between $158 million and $165 million.
Plus at least $85 million in free cash flow, right?
Right, and crucially, that guidance excludes any of their new M&A activity.
And the market obviously loved it. Shares gapped up like 17% to 19% in the pre-market. It broke the $60 mark after closing the previous session at $51.42.
It is a massive move.
So we have the huge earnings print, the management commentary, and the market reaction. Our mission for today's deep dive is to really look under the hood of these numbers. You have to ask, is this a sustainable turnaround, or is this raw volume kind of masking a highly risky structural pivot?
Well, to answer that, you really have to look at where the cash is actually coming from. The beat was overwhelmingly driven by their specialty technology solutions, or their STS segment.
Which is basically their bread and butter physical hardware, right?
Exactly. Think security cameras, mobility devices, networking gear. STS sales actually jumped 17.6% to $927.2 million.
Wow.
Yeah, so what you were seeing is a sharp cyclical recovery in North America. These large enterprise infrastructure deals that were, previously paused, they're finally being funded and returning to the pipeline.
Right, but then I am looking at their Intelisys and Advisory segment, which is their cloud and services brokerage, and it posted a steady but, much less flashy 7.2% growth, hitting $25.9 million.
It is a very different growth profile.
It is, and this creates a really fascinating dynamic. I mean, overall gross profit is up 14% on the back of that massive hardware surge, but the overall gross margin actually dropped from 12.9% down to 12.6%.
Yeah, that is the catch.
Right. It feels like Best Buy moving 10,000 TVs on Black Friday at a break-even price. Sure, top-line revenue looks incredible on paper, but the actual cash going into their pocket per unit is shrinking. So is this hardware boom just a high-volume doorbuster distraction from underlying margin compression?
You have hit on the exact tension in this report. Hardware distribution is just inherently a lower margin cyclical game.
Right.
So when you move incredible volume, that product mix naturally pulls down your overall percentage. Management knows they cannot just keep moving boxes forever if margins are structurally shrinking like that.
Which makes sense.
Yeah, and that is exactly why on the call they emphasize shifting from a mindset of, quote, defending market share to a much more aggressive winning mentality.
And by winning, they apparently mean buying their way into a completely different business model. Because right alongside these earnings, they announced a $220.5 million all-cash acquisition of MicroAge.
Exactly. This is a massive strategic pivot to capture higher margin recurring revenue. MicroAge expands their total addressable market way beyond traditional hardware distribution.
Pushing them directly into managed IT services, right?
Yes, we are talking cloud infrastructure, cybersecurity, AI. Instead of just selling the physical routers, they want to be the ones managing the security protocols running on them.
Oh, I see.
It is a classic move up the value chain to stabilize those exact margins you were just questioning.
But let's pump the brakes on the bullish M&A narrative for a second here, because changing your entire business model while you have immediate operational fires to put out seems pretty risky.
It definitely adds complexity.
Right. For one, they just expanded their HPE partnership to include Juniper Networks, but Juniper is facing severe supply constraints right now. Management even admitted this logistical headwind is going to push any real sales momentum into the second half of the year.
Yeah, that is a very real execution risk. And they are also putting out fires internationally, specifically in Brazil.
Oh, yeah, I saw that.
Sales down there plunged 21.6% in Q4. The weakness was so severe, they actually had to execute headcount cuts just to protect their bottom line profitability in that region.
Man. And frankly, integrating a specialized service arm like MicroAge into a legacy hardware distributor is, well, it is notoriously difficult. You are talking about blending two entirely different corporate DNAs.
Precisely. You are trying to shift a workforce from a transactional one-off sales culture into a relationship-based recurring revenue model.
Which is a huge leap.
Right. If they fumble that integration, that $220.5 million cash outlay instantly becomes a heavy debt burden rather than a growth engine.
Which leaves you with this final provocative thought. The core hardware business is booming, and they are buying their way into high-margin services. It sounds great, but there is a flashing cautionary signal here, which is recent insider selling.
Yeah, that caught my eye too.
Specifically, the CEO just offloaded 25,000 shares. So if you're analyzing this stock, you have to ask yourself, can ScanSource aggressively integrate a massive new services arm without taking their eye off the highly profitable core hardware business that is currently paying the bills?
It is the ultimate execution test for the upcoming fiscal year.
We will see how they navigate it. Just something for you to ponder as this plays out. Make sure to follow the show for your daily earnings coverage.